So hello all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your examination. So today we are doing the amendment videos which are applicable for your May 2026 exams, September 2026 exams and Jan 2027 exams. Now let me tell you, these amendments are applicable for those students who have not been able to clear their exams unfortunately in Jan 2026. So if you have not been able to clear your exams in Jan 26 and now you are willing to give your exams in next attempts, then this particular amendment video is relevant for you. If you have already taken our May 26 batch, regular batch or exam oriented batch, already if you have enrolled with our regular batch or exam oriented batch of May 26, September 26, Jan 27, then this video is of no use to you because all these amendments are already covered in the respective batch. Again, I am saying this video is more relevant and only relevant to those students who have not been able to clear their exams in Jan 26 and now they are planning to give their exams in May 26 and onwards. So because in Jan 26 Finance Act 2024 was applicable and in May 26 Finance Act 2025 is applicable, the entire Finance Act changes and therefore there are a lot of amendments which may be applicable for your exams. So from where we will get the notes of the amendment? The notes of the amendments you will get it from our new books which are available on our website. You can go and purchase that books from our website. There is no separate sheet available for the amendment as such, because one amendment is in PGBP, one is in capital gains, one is in search and seizure. Some amendments are completely changed also, like search and seizure completely changed. Total change as compared to what we have done in the last year. So yeah, the amendment you will get incorporated in our new books which are available for purchase from our website. Okay. Now without wasting any further time, I am doing all the amendments from our color book only. Now the very first amendment which is there in front of us is in the chapter of profit link deduction. A small amendment is there, not great as such. So the first amendment is in section 80 IAC, which is on, I will also say the page numbers everywhere, on page number 3.2. In 80 IAC, the amendment is the dates they have increased. They have extended the dates over here. Earlier, one of the condition of 80 IAC is the company or LLP is incorporated on or after 1st April 2016, but before 1st April 2025. So now that 25 is extended to how much? It is extended to 30. They have extended this particular time limit by 5 years. Now, even if the company is incorporated till 2030, you can enjoy the benefit of this section. Okay, this is the first amendment that you can see. I have to turn pages, so it will take some time for me to go from one page to another because I have to check the amendments where it is applicable. In MAT AMT, there is no amendment. There is no amendment in MAT and AMT. In assessment procedure, there are some small amendments. Like, if you come to section 143.1, 143.1, that is the return processing section. In this, there is a small amendment which is on page number 6.10. Please come to page number 6.10, all of you, which is return filing provision. Shall we? Let's talk about this amendment, what is there on page number 6.10. Now, we all know that under section 143.1, once you file the return under 139 or 142.1, the return goes to Bengaluru for processing in the software, and the software processes the return and find out some mistakes and then sends you the intimation. Now there are a list of mistakes. There are around 6 to 7 mistakes which are there in 143.1, like the software will identify arithmetical error. The software will identify incorrect claim which is apparent from any information in the return. Like that, software will identify around 6-7 mistakes. Now they have added one more point in the list of mistakes over that is point number 2A. Now what is this point? This point says that any such inconsistency in the return with respect to the information in the return of any preceding previous year as may be prescribed. Now what do I mean by this? Now they are planning to put one more point over here where they are saying that suppose this is the ITR of current year. This is the ITR of current year 25-26. Now they will compare this ITR with the last year, that is 24-25. And if there is any inconsistency between the ITR of 2 years, then the software will add back the inconsistency. Now, what will be that inconsistency? That I don't know. Sir, why you don't know? You are a teacher, you should know. I don't know, because the law has said that we will prescribe that. What does the law say? The law says that we will prescribe that particular inconsistency. I don't know what is that inconsistency. It means they will bring some rules for this particular inconsistency. Now, whenever they will bring the rule, that time I will be able to say. So far, they have not brought the rules, so I will not be able to say. But the funda is very clear. In the current year ITR, if there is inconsistency in the current year ITR as compared to the last year ITR, the software will add back. Now, what can be that inconsistency? The inconsistency can be change in the nature of business. The inconsistency can be a great change in the GP ratio. It can be anything. I don't know what can be that inconsistency. Whatever is the inconsistency, the software will pick, will add back. Will add back, and after it is added back, the department will send you the notice. Will send you the intimation. So this is what this small amendment is all about. Let's go on to the next amendment. What is the next amendment? The next amendment, there is nothing here, there is nothing here, there is nothing here, there is nothing here. There is nothing in the income tax authority and the powers. There is no amendment in 147, fortunately this time. Yes, there are a lot of amendments in search and seizure. I will come to that in a while. But before that, one amendment I would like to say over here, which is on page number 6.22. Page number 6.22, you have to come to point number 12 over here. There is one amendment over here. Let me tell you about this amendment first. What is this amendment? Whenever the officers take the books of accounts in their custody, in any assessment, regular assessment, best judgment assessment, income escaping assessment, search and seizure assessment, whenever the officers will take the books of accounts into their custody, it is their duty that after a particular point of time, they have to return the books to the assessee. They have to return the books to the assessee. So what is the time limit to return the books to the assessee? Earlier, the time limit was within 1 month from the end of the month in which the assessment order was passed. Earlier, the time limit was within 1 month from the end of the month in which the assessment order was passed. So suppose the assessment order was passed in January 26th, the assessment order was passed. Then earlier the time limit was it has to be given back to the assessee within 1 month from the end of January 26th. That is still 20th Feb. But now they have changed the time limit to within 1 month from the end of the quarter. Now what do we mean by this? Now you have to give it back within 1 month from the end of this Jan 26 quarter. That is within 1 month from the end of March 26. So now the time limit is changed. Instead of month, they have replaced the word month with what? The word quarter. So now you have to replace. Now you have to do what? Now you have to give it back to the assessee within 1 month from the end of the quarter. So this is the small amendment which is there over here. I hope it is clear to all of you. Next amendment is a very big amendment. That is the block assessment search and seizure, which came last year only. From 1st September 2024. I have explained you this in great detail. This is completely changed now. Now because there is a complete change over here, what I will do, I will make a separate video for it. A separate video. Part 2 will also come. Part 2 will have only 2 things. One, rest all amendments I will cover in this part. Part 1 will cover all amendments except 2 amendments. That is search and seizure amendment, and second one is transfer pricing. One small amendment is there that will also come in part 2. So this entire discussion I will do in part 2. I am not doing it today because there are lot of amendments over here. I will be putting part 2 by the end of day or by tomorrow. Don't worry. Okay. See, there are a lot of changes. I have told you in the class, if you remember, that the computation of total undisclosed income under the block of asset mechanism, under the block assessment mechanism is wrong. We have written in our book also that requires urgent attention and that requires a great amendment. So the law has made the amendment in the current Finance Act and they have changed all the mistakes. Whatever mistakes were there, they have rectified all of them. Don't worry. So I am not saying about this today. I will be speaking about this in the next session, which I'll upload today only or tomorrow mostly. Let's move on to the rectification of mistake chapter. There is no amendment over here. Then coming to the appeal and revision chapter, there is no amendment here also. There is no amendment, no amendment, no amendment, no amendment, no amendment. Okay. No amendment. No amendment. Time limits, no amendment. Whatever amendment is there, this time limit is of amendment of block assessment only, which I will cover over there. Don't worry. Now penalty, there are some amendments, but before there is one amendment in PGBP also, which is the change in the limits of MSME. MSME limits have changed. Yes, micro and small enterprise limits have changed now. Now come to page number 1.31. Micro and small enterprise limits are changed now. How the limits are changed now? For micro enterprise, earlier it was, I'll put the earlier limit if you remember, it was 1 crore here, now that has become 2.5 crore. It was 5 crore here, it has become 10 crore. Now this was also 10 crore now, that has become 25 crore. And this was 50 crore, that has become 100 crore now. So the limits have changed now under MSME, micro and small enterprise definitions have changed. Please check this particular thing. I hope it is clear to all of you. Is it clear? I hope it is clear. So 1 crore has become 2.5 crore, 10 crore has become 25 crore, 5 crore has become 10 crore and 50 crore has become 100 crore. Now coming back to the chapter of penalty. I have to turn the pages because there are a lot of amendments over here. Now, in the chapter of penalty, there is no amendment in section 270A. 270A is very straightforward. Yes, 270AA. On page number 10.3, 270AA is there. That is, if you want immunity from penalty under 270A, you have to make an application under 270AA to the assessing officer. Within 1 month from the end of the month, within 1 month from the end of the month in which the order is received. You also have to pay the tax and interest within 30 days. You should not file an appeal, and then the AO will pass an order deciding whether to give immunity or not. And that time limit is changed now from 1 month to 3 months. Earlier, this time limit was 1 month. Check it in your old books if you want. Now that has become how much? That has become 3 months. Check it, please. So this is a small amendment that 1 month has become what? 1 month has become 3 months. I hope it is clear to all of you. Then all these things are same only. Now, in 269SS, if you violate 269SS, the penalty will be imposed under 271D. Earlier it was by Joint Commissioner, now it is by Assessing Officer. From 1st April 2025, they have removed the word Joint Commissioner and they have put the word Assessing Officer, which may also include Joint Commissioner. Because Assessing Officer means Income Tax Officer, it means Assistant Commissioner, it means Deputy Commissioner, it means even Joint Commissioner. Earlier it was only Joint Commissioner, now they have expanded the scope to give the power to all kind of assessing officers. Similarly, in 269T also they have changed the penalty under 271E. They have extended this to assessing officers, not only to joint commissioners. I hope it is clear to all of you. So such small amendments are also there and big amendments are also there. Both kind of amendments are there. Next is the change in the time limit to pass a penalty order. Now pay attention, please. Section 275, which is effective from 1st of April 2025. Now this they have made it very simple. Earlier what used to happen, for different penalty, penalty is also a proceeding, and for that also the AO and the respective authorities have to pass an order. By passing a penalty order, and that by passing a penalty order you can say that the penalty proceedings are completed. So penalty is also a proceeding which can be completed only by passing a penalty order. So what is the time limit to pass penalty order? So earlier what used to happen, earlier for every kind of penalty there was a different time limit. Now there are hundreds of penalty under income tax law. All of them have different time limits. All. So now the law has consolidated all of them and given one time limit for everybody. All penalty orders will be passed within one time. What is that time? Let's see. Penalty must be imposed within 6 months from the end of the quarter. First of all, it is again from the end of the quarter now, not from the end of the month. Within 6 months from the end of the quarter, in which point number A, point number B, point number C, point number D, point number E has happened. What is point number A? Let's talk about all point one by one. The basic time limit is same, within 6 months from the end of the quarter. Now you need to check the events in which the proceedings in the course of which action for imposition of penalty has been initiated are completed. If the relevant assessment or other order is not subject matter of appeal under 246, 246A or 253. This they are talking about what you know. This they are talking about, see how penalty is imposed by AO. Penalty is imposed by AO because AO would have found some undisclosed income during the assessment. So whenever the AO will pass the assessment order within 6 months from the end of that quarter, whenever the AO will pass 143.3 order within 6 months from the end of that quarter. Whenever the AO will pass 144 order within 6 months from the end of that quarter. Whenever the AO will pass 147 order within 6 months from the end of that particular quarter. This is what point number A wants to tell. Then, if CIT is finding some undisclosed income in 263 to 64, then CIT can also impose penalty. So, CIT will count within 6 months from the end of the quarter in which the order under 263 and 264 is passed. Similarly, appellate authorities can also find out. So, in that case, within 6 months from the end of the month in which the appellate authority has passed the order. Similarly, ITAT can also find out something. So, within 6 months from the end of the quarter in which the ITAT has found, and in any other case, like penalty for tax audit, penalty for not maintaining books of accounts, it is within 6 months from the end of the quarter in which the notice is issued. So, you need to just understand the points. First one is for assessment proceeding. Whenever the assessment proceeding will be completed within 6 months from the end of that quarter. Second, third, fourth is for appeal and revision proceedings. Last one is your normal penalties. I hope it is clear to all of you. The time limit is common within 6 months from the end of the quarter. If it is an assessment, then from the end of assessment. If it is appeal revision, from the end of appeal revision order. If it is a normal penalty, then from within 6 months from the end of the quarter in which the notice is issued. I hope it is clear to all of you. Now next amendment, page number 10.9, which is on 276B and BB, prosecution for non-payment of TDS and TCS. Now, we all know that last year I have told you one amendment that generally what used to happen earlier. Suppose a person has not deducted the TDS, or if he has deducted the TDS but he has not paid the TDS. But later on, before filing the TDS returns, he has paid the TDS. He has paid the interest, he has filed the return also. Still he was prosecuted. I understand he has deducted the TDS but he has not paid by 7th of following month. I agree. But he has rectified his mistake by paying interest, by filing the return, and by paying the TDS. He has rectified the mistake before filing the TDS return. Still the department used to launch prosecution. So last year the government said that no. If a person has deducted the TDS and paid the TDS before filing of return and paid the interest, you cannot launch prosecution. But that amendment was only for TDS. It was not for TCS. So now Finance Act 2025 has made an amendment that that particular benefit will also be extended for TCS also. Check it please. Failure to pay TDS or TCS or dividend tax to the government is punishable with rigorous imprisonment of minimum 3 months to 7 years. Exemption from prosecution applies if the tax deducted or collected for a quarter is paid to the central government by the due date for filing the quarterly TDS and TCS returns. So, if you fail to pay, that's okay. But if you have paid before filing the TDS and TCS returns, you will not be launched with prosecution. You will be exempted from prosecution. I hope it is clear to all of you. So, these are some of the amendments which are there in the chapter of penalty. Now, let's go ahead with the next chapter. Next chapter, what is the amendment, sir? Securitization, Dispute Resolution Committee, no amendments. Set off and carry forward, no amendments. Investment fund, no amendments. Yes, in Securitization Trust, chapter number 14, there are some amendments. What are the amendments, sir? Whenever there is a change in TDS rate, whenever the Securitization Trust makes payment to resident and individual HUF, earlier the rate of TDS was 25%, that has been reduced to 10%. So that 25% has been reduced to 10%. Similarly, if it is paid to resident other than individual and HUF, like company, firm, AOP, BOI, then it was 30% earlier. Go and check your old books. So that 30% is also reduced to how much? It is also reduced to 10%. So 25% is reduced to 10% and 30% is also reduced to how much? It is also reduced to 10%. I hope it is clear to all of you. So it is just a relaxation in the TDS rate. Now let's talk about the TDS amendments. Now a lot of amendments are there in TDS. We need to talk about all of them one by one. The very first amendment is on page number 15.3, that is TDS on interest on securities. Now what is this amendment? There are two amendments over here. One is important, one is hopeless. One is a mistake. Earlier in this section, there was no threshold. It means even if you pay 1000 interest, 1000 rupees interest, you have to deduct TDS. There was no threshold in this section. But now in Finance Act 2025, they have put a threshold of 10,000 rupees. Okay. Up to 10,000 rupees payment in a financial year, not subject to TDS. If it crosses 10,000 rupees, then you are supposed to deduct the TDS. Okay, understood, sir. So earlier this section did not have any threshold only. Now there is a threshold of 10,000 rupees. Okay. Second amendment, there was an exception over here. The TDS shall not be deducted in the following cases: if the debenture is issued by public company and interest is paid to individual HUF and it is paid by account paycheck and the interest does not exceed 5,000 rupees. Here there was a threshold of 5,000. Now that they have increased to 10,000. So this also they have increased to 10,000, from 5k to 10k they have made. But this is hopeless amendment. See, when there was no threshold, this 5k makes sense. Because there is no threshold in the section, therefore 5k is a relaxation. But now the question is, if by default the section has 10,000 rupees threshold, what is the use of increasing this to 10,000? Even if you don't increase this to 10,000, anyways 10,000 is the basic threshold of this section. So making an amendment from 5,000 to 10,000 over here is of no use. Okay, this they have made a blunder. Again I am saying, if there is no threshold over here, then in some circumstances you can increase the threshold to 5,000. But if there is already a 10,000 rupees threshold, what is the use of this 10,000 below? It's of no use. It's a waste of time. Okay. So this is what this small amendment is all about. Nothing great as such. Coming to 194A, very important amendment. In this also they have changed the limits. In TDS, in many sections they have changed the limits. Limits they have changed. Last year, what they have done, you know? Last year they have changed the rates of TDS. But this year they have changed the limits of TDS. Like, if a bank or a cooperative bank or a post office pays interest, what was the limit last year? 40,000. Now that has become 50,000. How much it has become? 50,000. 40 has become 50. And what if I make the payment? What if the bank, cooperative bank and post office make the payment to resident senior citizen? Then it was 50,000. That has become 1 lakh. So the limit of 40 has become 50 and the limit of 50 has become 1 lakh. What about any other person? If any other person other than bank, cooperative bank and post office make the payment, it was 5,000. Now that has also become 10,000. So 3 limit change. First, 40,000 has become 50, 50,000 has become 1 lakh and 5,000 has become 10,000. Check it please. So in this entire section, these limits will change. Okay, I hope it is clear to all of you. Now, earlier we used to say if a firm pays interest to partner, then TDS is not applicable. Even today it is not applicable under this section. If a partnership firm is paying interest to partner, this section will not deduct TDS. But yes, new section has come, 194T. There you have to deduct TDS. Which I have explained you last year also. I will explain you again in this year. We have covered in last year books also. Because this 194T came in last year but it was applicable from this year. They announced last year but applicable from this year. So wherever it is 40,000, 50,000, it has become 50,000, 1 lakh. And wherever it is 5,000, it has become 10,000. Now next amendment is also a very important amendment in my eyes. 194B for lottery, crossword, etc. 194BB. 194BB is for horse race. Now they have changed the limit over here. How the limits are changed, sir? The limit is 10,000 only. No, they have not changed the amount of the limit. They have changed the sentence over there. Earlier it was where the aggregate amount in a financial year does not exceed 10,000. Now they have removed the word aggregate amount and now they have written the word single transaction. What can be the implication of this? Till last year it was aggregate winning should be more than 10,000. But now it is single transaction should be more than 10,000. It means if I win one lottery of 8,000 and one lottery of 7,000 rupees, last year aggregate was more than 10,000. So TDS was applicable. This year single is less than 10,000. Therefore TDS will not be applicable. So in the current year you have to check the single transaction, not the aggregate transaction. I hope it is clear to all of you. Single transaction should exceed. Every lottery winning and every horse race winning should exceed 10,000 rupees. Then only this section is applicable, 194B and 194BB. I hope it is clear to all of you. Let's move on to the next section. 194C, there is no change. 194D, yes, there is a change. TDS on insurance commission. The threshold has changed to 20,000 rupees. I think so. The rate was also 1% last year. Just check it from the book. Okay, whatever is the rate mentioned over here, just write down this rate only in your books. So the threshold is increased from 15,000 to 20,000, and this 2% was 1%, I think so, last year. Just check it once. Or 2% was 5% last year. I don't remember but there is some change in this. So why you have not done this green, sir? This was also amended last year but applicable from current year. That's the reason I have not amended. This 2% was also amended last year but applicable from current year. So two amendments to 20,000, and this was 5% or 1%. I don't know what it has become 2%. This 10% is same only. That was 10% last year also. Yeah, this year also it is 10% only. Now next, 194G, commission etc. on sale of lottery. That year also the threshold has been increased from 15,000 to 20,000. Now next one, 194H. Here also the threshold has been increased from 15,000 to 20,000. All three places thresholds are increased. All three commission section thresholds are increased from 15 to 20. 194D, insurance commission. 194G, lottery commission. 194H, your normal commission. Rest all are same. Now 194I, very important amendment. Very important amendment. What is the amendment, sir? Pay attention. 100% a question will come on this. Old provision, new provision. What was the old provision limit, threshold? It was 2,40,000 rupees per annum. Now they have changed that limit to how much? Rupees 50,000 per month. Is there any change? There is a great change. Don't say that 2,40,000 has become 6 lakh. No. 2,40,000 has not become 6 lakhs. 2,40,000 per annum has become 50,000 per month. There is a great difference between both of them. Sir, what is the implication? Suppose I have joined the property. I have taken the property on rent from Jan 26 to March 26. Or rather, I will write over here from Jan 25 to March 25. And my rent per month is how much? It is 60,000 rupees per month. So as per the old law, am I liable to deduct TDS? And the answer is no. Why? Because Jan, Feb, March, 3 months rent will be 1.8 lakhs, which is not crossing the annual limit. Therefore, no TDS. Till last year, we used to check the annual limit. Now, suppose this rent is of Jan 26 to March 26. Please comment and tell me whether you understood or not. It's a very important amendment, all of you. Suppose now the rent is 60,000 rupees per month. So 3-month rent is 1.8 lakh. Is TDS applicable? The answer is yes. Now you are not going to check the aggregate limit of the entire year. You are going to check the rent per month should exceed 50,000 rupees. So even if you take a premise on rent for 1 month in the entire financial year, say in the month of March you have taken the premise on rent and you are paying a rent of 70,000 rupees only for 1 month, then also TDS is applicable as per the new law. In the old law, it was not applicable. In the old law, we used to check the aggregate limit of the entire year. In the new law, we have to check only the per month limit, not the aggregate limit. I hope it is clear to all of you. So here the amendment has come. Check please. This is the amendment. Okay. Let's move on to the next part. 194IA, no amendment. In 194J also the limit has been changed from 30,000 to 50,000. Check it please. 194J limit has increased from 30,000 to 50,000 rupees. Okay. Next. In 194LA also check limit has been increased from how much to how much? 2,50,000 to 5 lakh rupees. Check it please. They will test all these limits to you all in examination. Be careful with this. They will test all these limits to you in the examination. Be careful with all these limits, please. So this 2.5 lakhs has become how much? 5 lakh rupees for compulsory acquisition by government. Okay. Then no change in IB, no change in M, no change in N, no change in O, no change in P, no change in Q. Just remember that along with Q, the TCS section of 206C1H is discontinued from 1st April 2025. 1st April 2025, TCS section is discontinued. One more thing is discontinued from this year is equalization levy. I may forget later on, so I am saying it now only. Remove the chapter of equalization levy from your study material. Okay, it is not applicable from 1st April 2025. Next. Now let's talk about 194T, which is our TDS provision. Now from 1st April 2025, the partnership firm has to deduct TDS. Partnership firm will also include LLP. They have to deduct TDS on what? On remuneration, interest, bonus, commission, salary. Remuneration, salary, interest, bonus, commission. Not on share of profit. Not on share of profit. They will only deduct TDS on remuneration, salary, interest, bonus, commission. Not on share of profit. Share of profit is exempt in the hands of the shareholder. Whose TDS will be deducted? Partner, residential status, both. Resident, non-resident, everybody is covered here. What is the rate? Rate is 10%. What is the threshold? Threshold is only 20,000 rupees in the entire financial year. It's very less. They should increase the threshold. It's very less. They should increase the threshold. This is nothing. It's almost a negligible amount. It's of no use. When TDS will be deducted? When you credit to partner account or when you pay to the partner, whichever is earlier. Whichever time you will credit to the partner and whichever time you will pay to the partner, whichever is earlier, at that time you have to deduct 10% if the aggregate payment in the entire financial year exceeds 20,000 rupees. Okay. 197A not applicable. Means the partner cannot give lower deduction certificate, low deduction certificate, no deduction certificate, form 15G, 15H, not possible. No exemption from deduction of TDS. TDS has to be deducted. Plus, while deducting the TDS, do not check whether the amount is taxable in the hands of partner or not. Whatever payment is credited, whatever payment is paid, whichever is earlier, you have to deduct TDS on the entire amount, irrespective of whether the amount is taxable in the hands of partner or not. Don't check all those things. That is not your job. Your job is only to deduct TDS on the amount which is credited to the capital account or which is paid to the bank account, whichever is earlier. You are not supposed to check how much is taxable and how much is not. Okay. I hope it is clear to all of you. 100% some questions might come on 194T. It's a very important section for us in examination and also in practical life. Let's go on to the next section. What is the next amendment, sir? Next amendment is over here in 271C and 271CA in both the sections. The officer has changed in both the sections. Earlier JC was there, now the assessing officer will come. So in both these sections, earlier joint commissioner used to impose penalty, now the assessing officer will impose the penalty. I hope it is clear to all of you. Okay. Now, there is one small amendment over here. That is the section 201 subsection 3 is the officer's power to pass an order to declare you assessee in default in case you do not deduct TDS. And 206C subsection 7A is to declare you assessee in default if you do not collect TCS. Now, there is a time limit to pass that order, that 6 years, etc., whatever is that. In that time limit, the government is giving you some exclusion. That if the proceedings are stayed because of any court, sometimes the proceedings are stayed because of court, na? If the proceedings are stayed because of any court, the court is coming in between and putting a stay on the court, stay on the proceeding. So whatever time will be lost, that much extra time you will get to complete the proceeding. That's it. There is nothing great in this. Okay. So first of all, you need to understand that this section talks about the AO's power to declare you an assessee in default. Now, during this entire process, the AO will send you show cause notice, then you will reply. This proceeding will go on for years and years and years. In between, if the court has put some stay on the proceeding, so that much extra time you will get. I hope it is clear to all of you. Next discussion is on TCS. Now coming to TCS amendments. Some very important amendments have happened in TCS. The very first amendment is this rate, and this rate has been reduced from 2.5% to 2%. First of all, check. Both these rates were earlier 2.5%. Now they have been reduced to 2%. First amendment. Amendment number 2, be very careful. Earlier there was only timber obtained under forest lease. Now they have put one entire line. Timber is also included or any other forest produced. So they have expanded the scope of this particular point. So now this point number 3 not only includes timber, it also includes any other forest products not being tendu leaves, because tendu leaves is already covered in point number 2. So point number 3 covers timber or any other forest produce. The rate is 2%. The rate is 2%. Okay. Now you will ask me what is forest produce. For that, go and read the Forest Act, Indian Forest Act 1927. CBDT said to understand the meaning of the word forest produce, you have to go and read the Indian Forest Act 1927. Sorry. Okay, if you have time, then you can read. If you don't have time, leave it. Okay. So what is the small amendment? Nothing great. First of all, first amendment is 2.5%. 2.5% has become 2%. Second, along with timber, now any other forest produce has also come over here. Okay. And tendu leaves is already covered in point number 2. This is the first amendment. Second amendment in TCS. You all might be knowing in 2061F in category 3 TCS, I have told you in the last year, I have told you that in category 3 TCS, the government has said that we will notify few more luxury goods which will be subject to TCS in this section if the consideration exceeds 10 lakh rupees. So last year the government has promised that we will notify few more goods if the consideration exceeds 10 lakh rupees. Few luxury goods we are going to notify here. So now the question is, have they notified? The answer is yes. Point number 4 talks about the provision that the government will notify any other luxury goods whose value exceeds 10 lakh as notified by central government except sold to RBI. If it is sold to RBI, then TCS is not applicable. So now the question is, what are those notified goods? Complete list is given in point number 5. Check it please. The notified goods are as follows. Wristwatch. If you are purchasing a wristwatch of more than 10 lakh rupees, you have to pay TCS. Any art piece such as antique, painting, sculpture, any collectible such as coin, stamp, any yacht, rowing boat, canoe, helicopter, any pair of sunglasses, any bag such as handbag, purse, any pair of shoes, any sportswear, equipment such as golf kits, ski wear, any home theater system, any horse for horse racing in race clubs and horse for polo. All these items, I am not saying you have to buy hard these items, but you need to be aware of these items. That these items are subject to what? TCS. At the rate of 1%. If the consideration exceeds, if the value of the product exceeds, how much? 10 lakh rupees. All these are luxury products. Sir, where we will get watches of more than 10 lakhs? Definitely you can easily get it. Painting, you can definitely get it. Yacht, obviously. Helicopter, obviously. Sunglasses, more than 10 lakhs? Yes. Shoes, more than 10 lakhs? Yes. You get luxury shoes of 50 lakh rupees. So all these items are subject to TCS if it exceeds how much? If it exceeds 10 lakh rupees. Okay. So this is an amendment not made by FA25. It is an FA24 amendment but notified recently. They have notified in a notification recently. So this was not applicable till last year. Now it is applicable. Now in 1G all the limits have changed and 1H is deleted. 206C 1H is completely deleted, so that is removed. 1G, lot of relaxation. First of all, if you take a loan from a financial institution in India and you remit outside India for education, earlier it was subject to TCS up to 7 lakh, no TCS, above 7 lakh 0.5%. Now this is completely relaxed. Check. Now this is not subject to TCS. Absolutely no TCS on this. Absolutely no TCS. This is not subject to TCS. Okay. Second, all other limits are same only, just they have increased the limit from 7 lakh to 10 lakhs. So wherever it was 7 lakh, that has become 10 lakh. Check please. So there are two amendments over here. If you take a loan from a financial institution as defined in ATE in India and you send outside India for education, no TCS. Earlier it was 0.5% above 7 lakh. Now no TCS irrespective of the amount. Rest all amounts have changed from 7 lakh to 10 lakh rupees. Check it please. I hope it is clear to all of you. Is it clear? So this is what this amendment is all about. Now, even in this section 269 ST, 271 DA, earlier the penalty was imposed by Joint Commissioner. Now the assessing officer will impose the penalty. Most of the places where Joint Commissioner was relevant to impose penalty, now they have changed that authority from JC to assessing officer. Okay. So this is what this chapter is all about. Now coming to the chapter of virtual digital asset. Now there is a small amendment on virtual digital asset over here. Okay, if you purchase any cryptocurrency, etc., you purchase from whom? You purchase from certain exchange. Okay, I will purchase from CoinDCX, WazirX, different kind of exchanges are there. Platforms are there through which I am going to purchase this. So now the government has said that those platforms have to report certain things. What they have to report, when they have to report, how they have to report, everything will be prescribed. So those platforms have to report few things with respect to cryptocurrency transactions. Let's see. Reporting requirement. A prescribed reporting entity. Who will report? I don't know. Government will prescribe. Must furnish a statement on crypto asset transaction for a specified period within prescribed time, in prescribed form, and to the designated income tax authority. I don't know anything. I just know one thing, that they want the platform or certain institutions to report certain transactions with respect to what? Cryptocurrencies. Who will report? Prescribed entity will report. What they will report? I don't know. In prescribed form they will report. When they will report? In prescribed time. For how much period they will report? 3 months, 6 months, 1 year. How much period they will report? I don't know. To whom they will report? I don't know. So they will prescribe all these things. Let's wait. When they will prescribe, I will address. If they don't prescribe, that's great for us. Second, suppose the platform has filed a statement. Now the prescribed authority finds some defect in that. So they will notify the platform and they will tell them to rectify the defect within 30 days or extended period. If they fail to rectify, then it will be treated as inaccurate under the Act and the action will be taken. It is similar to 139 subsection 9, defective return. You file the return and the return is defective. So the department gives you an option to rectify the defect. Same way, you file the return. You file the statement. Which statement? This statement you file, which is going to be prescribed in this section. The statement which is going to be prescribed in this section, you file the statement and there is a defect in that. So the department will intimate you. You have to rectify the defect within 30 days or extended period. If you don't rectify, it will be considered to be inaccurate under the Act and relevant action will be taken against you. Third, non-compliance notice. If a required statement is not furnished on the time, the income tax authority may issue a notice requiring to submit the statement within 30 days. It is similar to 142 subsection 1 clause 1. Let's try to relate with something which we know. That if you don't file the return on time, we will intimate you to file the return within a period specified in the notice. Same way, if you don't file the statement on time, the department, the prescribed authority will intimate you that please file the statement within 30 days. Okay. Then, correction of inaccuracies. This is similar to 139.5. That if once you have filed the statement and if you discover any inaccuracy, in the statement filed under point number 1 or is the statement filed under point number 3, if you find an inaccuracy, you may rectify the inaccuracy within 10 days. Within how many days? 10 days. Similar to 139.5 only. This is like a revised return. You have to file a revised statement. Then the government has been given a lot of powers to make rules. Rules for registration of reporting entities with income tax authorities. The reporting entities have to register with the authorities. Which informations have to be reported. Due diligence has to be conducted by the reporting entity of the crypto users. Whether the crypto users are having what? Legal source of money. Whether the crypto users are infusing some terrorism money, some black money. That due diligence has to be done by the whom? By the reporting entity. So this is what this section is all about and this amendment is all about. I don't think so personally this is very important for exam. Because till the time they don't prescribe the things, it may not be much relevant to us. Okay. Now let's go on to the chapter of capital gains. Let's talk about capital gains amendments now, one by one. The very first capital gain amendment is as follows. And that is in the definition of capital asset itself. Capital asset means property of any kind held by an assessee. Capital asset means any securities held by 5 Now in that list, one more item is added. Capital asset means any security which is held by an investment fund referred in 115 UB. Sir, who is this investment fund? This is AIFs, Alternative Investment Funds, Category 1, Category 2. So whatever securities are held by investment funds, that is 115 UB investment funds, those securities will always be called as capital asset. They will never be called as stock in trade. Always capital asset. Always capital gains, no PGBP income for them. I hope it is clear to all of you. The way the securities held by FIIs are always capital asset, similarly the securities held by investment funds are also always capital asset. Second amendment is with respect to ULIP. ULIP to which exemption under 1010D does not apply due to 4th and the 5th proviso is a capital asset. Now 4th and the 5th proviso covers only amount criteria. So what does that mean? If an exemption does not apply due to a violation of amount criteria, then it is a capital asset. What about what about if the exemption does not apply due to violation of percentage criteria? Then also it is capital asset. Na? See, from 1st February 2021, if you want to make your ULIP exempt, you have to fulfill two conditions: 1% and one amount. The capital asset definition was saying that capital asset is possible only if the exemption is not due to violation of amount criteria. What about if you violate a percentage criteria? Then it is not a capital asset. So this is just a clarificatory amendment. They have removed this word 4th and the 5th proviso. Now they are using the word if the exemption does not apply. Because of which criteria? Any criteria, percentage, amount, doesn't matter. In both cases, if you violate, moral of the story, if you violate a percentage criteria, then also it is a capital asset. If you violate an amount criteria, then also it is a capital asset. I hope it is clear to all of you. So this is a small amendment with respect to ULIP. Let's go ahead with the next one. Let's see what is the next amendment. Yeah, indexation for the current year is 376. Be careful. Okay. Now indexation is only useful in some very handful cases, not much. Very few cases are there in which indexation will be useful, but the current year indexation is 376. Now coming to page number 17.10, all of you, important amendment. Treatment of ULIP. They have made some consistency in treatment of ULIP. Earlier what used to happen, if percentage criteria was violated now, then 112 provision was applicable, section 112. If percentage criteria was violated, section 112 was applicable. And if amount criteria was violated, then section 112A was applicable to the assessee. So if you violate a percentage criteria, you have to pay tax as per capital gains 112, and if you violate an amount criteria, you have to pay tax as per capital gains 112A. Now they have removed this inconsistency, and they have said whether you violate a percentage criteria or whether you violate amount criteria, all of them will be taxable under 112A only. 112 is not applicable for ULIP anymore. For ULIP, only 112A will be applicable. Whether you violate a percentage criteria, then also 112A will be applicable, and whether you violate an amount criteria, then also 112A only will be applicable for ULIP. I hope it is clear to all of you. Is it clear? I hope it is clear. Now second amendment is with respect to life insurance. We all know that if you want to exempt your life insurance policy on or after 1st April 2023, you have to fulfill percentage criteria, and your aggregate premium amount criteria should not exceed 5 lakh rupees in the entire financial year. You have to fulfill two conditions, we all know. But this second criteria is not applicable for few people as per Finance Act 2025. Amount criteria is exempted for few people as per Finance Act 2025. Who are those fortunate people for whom the amount criteria is exempted? If you go and buy a life insurance policy which is issued by an IFSC insurance office. So if the insurance policy is purchased from Mumbai on or after 1st April 2023, then you have to fulfill percentage and amount, both the criteria. But if the insurance policy is purchased from IFSC insurance office on or after 1st April 2023, then you have to fulfill only percentage criteria. Amount criteria is not applicable for them. So all the rich people will go where? If you want to buy an insurance policy whose premium is more than 5 lakhs, you will go to IFSC insurance office in Gujarat and buy from there. It is exempt. Their amount criteria is not applicable, only percentage criteria is applicable. I hope it is clear to all of you. Next amendment. Next is a small amendment which came last year only, page number 17.13. Definition of specified mutual fund. Sir, what is a specified mutual fund? Specified mutual fund is nothing but a debt mutual fund which invests more than 65% of its total proceeds in what? In debt or in money market instruments. So if you have raised 100 crore rupees, more than 65 crore you should invest in debt or you should invest in money market instrument or in a fund which invests 65% or more of its total money in debt or money market instrument. So if I want to become a specified mutual fund, I should invest more than 65% of my proceeds in debt or money market instruments, or if I'm not directly investing in them, then I should invest in a fund which invests similar to that. So I have two possibilities. I can directly invest in debt and money market instrument. If I directly invest in debt and money market instrument, then my percentage should be greater than 65% in the debt or money market instrument. If I do not directly invest in the debt and money market instrument, I invest in a fund. Then that fund should invest at least more than 65% in debt and money market instrument. That is written in the bracket. Check it, please. I hope it is clear to all of you. Now, slum sale, there is no change, nothing great. All these things are same only. In amalgamation, there is a very big change now. What is the big change? In amalgamation, there is a change. In conversion of firm or proprietor into company, there is a change. In conversion of unlisted private company into LLP, there is a change. In all these three cases, earlier, the losses of the amalgamating company was allowed to be carried forward by the amalgamated company for another 8 years. Now it is balance 8 years. Not balance 8 years, balance years you can say. If entire 8 years are balanced, then balance. If 6 years are left, then 6 years. Now it is only allowed for balance number of years, not for another 8 years. Yes, for demerger, it was balanced from the beginning only. In demerger, there is no amendment. In demerger, earlier it was also balanced, now also it is balanced. More of the story, if the amalgamation and conversion is happening before 2025, 1st April 2025, then it is carried forward for another 8 years. But if it is happening on or after 1st April 2025, then you will be allowed to carry forward the losses only for balance number of years, not for another 8 years. I hope it is clear to all of you. Is it clear? So very important amendment it is. Next. Let's see. Now, next amendment is in page number 17.22. Not much important. I don't think so. This is a very important amendment for examination. But nevertheless, we have to see every amendment. Next amendment is on 10.4D. Specified fund definition has been expanded. They have added few more people in the definition of specified fund. Specified fund means what? It means a fund which is established in India in the form of trust, company, LLP, body, corporate. And earlier there was only one category of person who has been granted a certificate of registration as category 3 AIF. Now in the definition of specified fund, there are few more people which are added. First, which has a certificate as a retail scheme. Point number 1, this has added. Or which is an exchange traded fund. Point number 2. And which satisfies the conditions as may be there under the International Financial Service Center Act. Therefore, there are two more people which are added to the definition of specified fund, which is having a certificate as a retail scheme or an exchange traded fund. Along with this, they have to fulfill other point number 2 and 3 condition also. So specified fund now includes a certificate holder of category 3 AIF also. A specified fund now includes a certificate person holding retail scheme or an exchange traded fund also. So there are 3 people in all, you can say. One is a person who has a certificate of AIF. Second, a person who has a certificate of retail scheme. Third, a person who has a certificate of ETF, exchange traded fund. All of them are considered to be what? All of them are considered to be specified fund only in the eyes of the law. One more amendment is there in the amendment of investment division of offshore banking unit. The time limit is changed. Earlier this time limit was 2025. Now they have extended that to 2030. That's the only provision which is over here. Here also it was 2025. So 2025 has been extended to 2030. Nothing great as such. Okay. No great amendment. Next amendment, here also in the relocation definition, they have changed the definition from, they have changed the time limit from 2025 to 2030. Earlier, the relocation was allowed only till 2025. Now, because the new Income Tax Act is coming and they don't want to change the act again and again. So, they have extended all the deadlines from 2025 to 2030. That's it. Further, in this section, what is happening? In this case, you are bringing an original fund from outside India to India, and you are making that as a resultant fund. That is a fund outside India by the name called as original fund. The law is saying close that fund and bring that fund all assets and bring that fund all unit holders in India and make a resultant fund in India. So there is a change in the definition of resultant fund. Sir, what is a resultant fund? Resultant fund means a fund which is established in India first of all. Secondly, it is established in the form of a company, LLP or trust. Thirdly, it is located in IFSC. Where it is located? IFSC. So what is the definition of resultant fund? It is not completed. I am just breaking down into multiple parts. First, it is located and incorporated and established in India. Second, it is established like a company, trust, LLP. Third, it is established not anywhere in India but in IFSC, Gujarat. Fourth, it has been granted a certificate of category 1, 2, 3 AIF, or it has been granted a certificate of retail scheme, or it has been granted a certificate of ETF, just like the specified fund definition. So they have a certificate of AIF or certificate of retail scheme or certificate of exchange traded fund. If all these four conditions are fulfilled, your fund will be called as a resultant fund. Okay, so you have to close your original fund outside India and bring your unit holders to this resultant fund. I hope it is clear to all of you. You can do this till 2030 now. Earlier it was allowed only till 2025. Next, what is the amendment, sir? Let's see. (112A) I have already told you earlier. 112A was applicable only due to violation of amount criteria. Now 112A is applicable even if you violate a percentage criteria. For what? For ULIP. So they have removed the word does not apply due to fourth and the fifth proviso. They have removed the word amount criteria. And they have written, if exemption does not apply, then come here. Because of which reason? Because of any reason. Because of amount criteria violation also come here. Because of percentage criteria violation also you have to come here only. Okay. 112A is applicable both the ULIP. Then in section 54 EC, there has been two more bonds which are issued. I think so. This was issued in the last year also. It was issued through a, it has been added through a notification. But in case you don't remember, then you check please. Earlier there was NHAI, REC, Power Finance Corporation, Indian Railway Finance Corporation. Now there are two more bonds which are added over here. Housing and Urban Development Bond, HUDCO, Housing and Urban Development Corporation Limited. And second, Indian Renewable Energy Development Agency, IREDA. So these two bonds are added to the exemptions under section 54 EC. I hope it is clear to all of you. Next amendment. Yes, next amendment, in case of amalgamation of cooperative banks also, the losses can be carried forward now for another 8, now for balance number of 8 years, not for another 8 years. Another 8 years is gone now. Another 8 years not possible. It is only for balance number of years. Okay. Balance years. What is this section actually, sir? Not very important, but still I'll tell you one. There is a cooperative bank. There is another cooperative bank. They are getting amalgamated. So whatever is the loss of the amalgamating cooperative bank, that can be carried forward by the amalgamated cooperative bank, but only for balance number of years, not for another 8 years. Sorry. ESOP, there is no change. Buyback, already they have changed last year. Income from other source, let's see what changes are there in IFOS. Yes, in IFOS, in the TDS of dividend, they have increased the limit to 10,000 rupees from 5,000 rupees. Check here. Earlier, this limit was how much? 5,000. That they have increased to how much? 10,000 rupees. Check it please. I hope it is clear. There is no other amendment apart from this. Okay. So this 5,000 limit has become 10,000. That's it. On page number 18.1. Then there is no amendment in deemed dividend. Yes, in deemed dividend there is one amendment in 222E. In some cases, this section will not be applicable. What is 222E? There is a closely held company and there is a shareholder who holds 10% voting power in the closely held company. Now, if this closely held company gives you loan then or advance, then that is deemed dividend. So, if the loan is received by a shareholder from a closely held company, what kind of shareholder? Who holds 10% voting power in the company, and if he receives any loan from such closely held company, then it is deemed dividend in the hands of the shareholder. But there is some relaxation which are given over here. Dividend shall not include following. What? Any advance or loan between two group entities which following the following condition is not treated as deemed dividend. So if the advance is given between two group entities, this is one group entity, then this is another group entity, they are giving advance to each other. This is not a deemed dividend. But when? Subject to some condition. What is the condition? One of the group entity is a finance company or finance unit in IFSC, set up as a global or regional corporate treasury center for undertaking treasury activities or treasury services. So one of the unit is in IFSC, which is set up as a finance company or finance unit, and it is a treasury unit of a company. The principal entity or the principal entity, parent entity of such is listed on a stock exchange in a foreign country other than the country outside India as specified by the board, and the parent is outside India. Now they are giving loan. Okay. So such loans are not subject to deemed dividend. Who are the two entities? One of the entity is located in IFSC, which can be called as a finance company or finance unit, and which is a global treasury head of the undertaking, which are taking care of the treasury services. And the another entity is a parent, which is listed in a recognized stock exchange outside India. Parent is listed outside India. Now, if there is any loan given, that will not be termed as deemed dividend in the eyes of the law. That is what it is mentioned in point number 3. I hope it is clear to all of you. Let's move on to the next amendment. Next amendment is on page number 18.5. Earlier, this exemption of dividend was only available for leasing of aircraft. Now it is also extended to leasing of ship. Check please. One company is engaged in leasing of aircraft. Another company is also engaged in leasing of aircraft. Both of them are in IFSC. Then the dividend received by one company from another is exempt. Now that was only applicable for leasing of ship companies earlier. Now that is extended, leasing of aircraft company earlier. Now that is extended to leasing of ship company also. Check it please. Dividend income of a unit of an IFSC engaged in the business of leasing of aircraft or ship from a company, same, being a unit of IFSC, engaged in again leasing of aircraft and ship, is not chargeable to tax. Both are in IFSC, both are engaged in leasing of aircraft, now leasing of ship also. They give dividend to each other, it is exempt, not subject to tax. I hope it is clear to all of you. Next amendment, let's go ahead. There is no amendment in IFOS now and 10AA. Yes, in mutual fund section, there is one amendment, small change in the threshold in 194K on page number 20.1. In 194K, the threshold has been changed from 5,000 to 10,000. Check it please. This threshold has been changed from how much to how much? It was 5,000 earlier. Now it has been changed to how much? It has been changed to 10,000. I hope it is clear to all of you. Okay. Now in advance tax, there is no amendment. Yes, in updated return, important amendments have come. Two important amendments have come in updated return. One, earlier the updated return was allowed to file till 24 months from the end of relevant AY. It means earlier, if this is previous year 25-26, assessment year 26-27. Earlier it was allowed to file updated return till 24 months from the end of relevant AY, that is till 31st March 2029. But now they have extended this to 48 months, that is 4 years from the end of relevant AY. Amendment number 1. So now you can file updated return up to 48 months from the end of relevant AY. Obviously, you have to pay additional tax. What is the additional tax, sir? For the first 12 months, it was 25%. That is, if you file up to 12 months, then 25% additional tax. After 12 months up to 24 months, then it was 50% additional tax. Now, after 24 months up to 36 months, it is 60%. And after 36 months up to 48 months, if you file, it will be 70%. So 20, 25, 60, 70. These are the 4 slabs of that additional tax that you have to pay. How to compute additional tax? Don't ask me. That we have done it in class with relevant questions. Okay. So this is the second amendment. First, they have extended the time limit to file updated return from 24 months to 48 months. Second, obviously, if they are extending the time limit, they have to change the additional tax percentage also. So for first 12 months and for first 24 months, it is same. 25, 50, 60, 70. 60, 70 is the amendment. Now, second amendment is as follows. Pay attention, it's an important amendment now. If you come to page number 22.1, point number 4, no updated return shall be furnished by any person for the relevant AY where long list is given. Then there is an amendment. There are two provisos which they have added over here. Provided that no updated return shall be furnished by any person where any notice to show cause under 148A has been issued in his case after 36 months from the end of the relevant AY. Now, what do I mean by this? Read this 3 lines, 2.5 lines properly. Read this 2-3 times and I will put one example on the board. Okay, shall I say? Now, let me put an example. This is previous year 25-26. Assessment year 26-27. Suppose 36 months have gone. It means 31st March 2030 gone. After that, AO has sent you 148A notice. What is 148A notice? Enquiry notice. Now, the moment this enquiry notice has come, you cannot file updated return. This is what this particular 2.5 line wants to tell you. Check it, please. No updated return shall be furnished by any person where a notice to show cause under 148A has been issued in his case after 36 months from the end of the relevant AY. So, have you been issued the show cause notice after 36 months from the end of relevant AY? Yes. Once this notice has come after 36 months from the end of relevant AY, you cannot file an updated return. But after this, what the AO will do, will pass an order under 148A. Now, there are two possibilities. Suppose the AO decides that your case is a fit case for 147, then obviously cannot file updated return. But now the second proviso says that, suppose if the AO says that your case is not fit for 147, it means you have not done anything wrong. Then the law says that you can file updated return. Check, please. The second proviso says that. Provided also that the fourth proviso shall not apply. It means this proviso shall not apply where an order passed under 148A determining that it is not a fit case to issue notice under 148. So, if the case is not fit case for 148, then you can file updated return. So, what is the ultimate conclusion of this? See, if a notice comes after 36 months, you cannot file updated return. In that case, you can only file updated return if the case is not fit for 147. So, after 36 months, you have to wait for the order for the AO to pass and decide whether it is a fit case or not fit case. If it is a fit case for 147, updated return not possible. If it is not a fit case for 147, updated return is possible in that case also. If you want, you can take a photograph of this, please. Fast, all of you. Let's move on to the next amendment now. After updated return. Yes, in taxation of trust, there are some amendments. Not much amendments are made in this year. Very few amendments are made already. We all know that a lot of amendments are already made in charitable trust in last few years. What is the amendment? Now pay attention, please. We all know that the registration of charitable trust has become streamlined. To make an application, the commissioner will check the application, will give you registration. In some cases, will give you provisional registration. In some cases, he will directly give you final registration. And that registration under any circumstance will be applicable up to 5 years. Now the law felt that giving registration for 5 years and calling the assessee back for registration every 5 years will lead to lot of what? Compliances. Every 5 years a person has to come for re-registration will lead to lot of compliances. So for some people, the government has increased the time limit of 5 years to 10 years. It is not extended for everybody. It is extended for some people. So who are those fortunate people? From this table, I will show you. Existing trust, it is applicable. New trust, it is not applicable. Provisionally registered trust, it is applicable. This it is applicable. This is applicable. This it is applicable. But it is not applicable who is a new trust. For new trust, it is not applicable. Apart from new trust, everybody it is applicable. Applying for registration every 5 years increases the compliance burden for trust, especially for smaller trust and institution. To reduce the compliance burden for smaller trust and institution, 12AB has been amended to increase the period of validity of registration of trust or institution from 5 years to 10 years. So they are increasing the time limit from 5 years to 10 years for some people. However, the increased period of 5 years is available only if the following conditions are satisfied. The application is made by trust under 12AC subsection 1, clause AC, subclause 1, subclause 2, subclause 3, subclause 4, subclause 5. It covers all cases except first time application. Who is making application for the first time, it is not applicable for them. Then whether the activity is commenced or not commenced, it doesn't matter. 25-26 is your first year of trust and first year of application, you cannot come. Or 25-26 is your first year of application, but the trust is very old, still you cannot come. If you are a first time applicant, you cannot come. It is not applicable for first time applicant. Whether the activities are commenced, still you cannot come. If it is not commenced, still you cannot come. Whether the activities are commenced or not commenced, you cannot come in both the cases. What is the second condition? Most important is the second condition. The total income of such trust, without giving effect to the provisions of section 11 and 12, it means before exemption. The total income of the trust before exemption does not exceed 5 crore rupees during each of the 2 previous years preceding the previous year in which the application is made. So now let me tell you for whom the limit has been increased from 5 years to 10 years. First, you should be an old applicant. This application should not be your first application. So you should be an old applicant. Second, your total income before giving exemption. Total income before giving exemption in both the last 2 years should be up to 5 crore rupees. Which to last year? The year in which you made an application. Suppose I made an application in 25-26, then the last 2 years will be 24-25, 23-24. The total income before giving exemption should be up to 5 crore rupees in the last 2 years. If these 2 conditions are fulfilled, so sir, for this person it is not available, for this person it is not available. For this person also it is not available, who has already commenced the activity. It doesn't matter whether you are already commenced the activity or not commenced the activity. It doesn't matter. If you are a first time applicant, you are not eligible for 10 years benefit. You are only eligible for 5 years benefit in that case. Okay. Now, one small amendment in cancellation of registration. The department will cancel registration if there is some specified violation. The commissioner will cancel your registration if you have done some specified violation. Now, what do I mean by specified violation? A long list is there. Now, one of the points in specified violation is if your application under 12A for registration is not complete or it contains false information or incorrect information, the department can cancel your registration in future. So now they felt that only because, see, if I am giving an application and if there is a false information, then I am wrong. If there is an incorrect information, then I am wrong. But if I forget to put some information, that can be genuine also. So if the application is incomplete, because of that reason you cannot cancel the registration, this is what the amendment is all about. So they have removed the word is not complete. So now the application can be, the registration can be cancelled only because of the reason of information containing false or of the information containing incorrect nature. So if the information is of incorrect nature or if the information is of false nature, the registration can be cancelled, but the information in the application is incorrect, is incomplete or it is not complete. Because of that reason you cannot cancel the registration. I am again telling you, you cannot cancel the registration certificate only because the application form was incomplete. Yes, if it was incorrect, you cancel. If it contains false information, you definitely cancel. I hope it is clear to all of you. Now, next amendment is also very important amendment, which is in the definition of specified person. Specified person is definition is amended in point number B. The definition of substantial contributor is amended. Till last year, what was the definition of substantial contributor? Any person who has given contribution of more than 50,000 during the financial year to the trust is a substantial contributor. So I am a trust, you are a donor, and if you have given me donation of more than 50,000 in the financial year, you are a substantial contributor. But now the amendment has been made, the definition has been changed. Now there are two limits over here. If in the entire year, if the donation given is more than 10 lakh rupees, is more than 1 lakh, or if the aggregate donation is up to 10 lakh rupees, it is exceeding 10 lakh, sorry. So now they have put two limits. This is which year going on, 25-26. If you have given me donation in the entire year of more than 1 lakh rupees, then you are a substantial contributor. Or in the current year, you have given me donation of only 70,000, but the total donations over the year till today is more than 10 lakh, then also you are substantial contributor. Earlier, we used to check only current year limit. Now we need to check the current year limit should exceed 1 lakh or the aggregate donation given till date should exceed 10 lakh rupees. Whatever is getting fulfilled is okay. Both the conditions are not sufficient. Both the conditions are not required. There is an or in between. Either current year donation should exceed 1 lakh or aggregate donation should exceed 10 lakhs. I hope it is clear. Second amendment is from point number D, they have removed the word substantial contributor, and from point number E also they have removed the word substantial contributor. Check it please. They have put other than substantial contributor. So in point number D and point number E, they have excluded substantial contributor from here. Okay, let's go to the next amendment. I think so there is no amendment now in trust. Trust chapter is fully amended. Now alternative tax regimes. No amendment in alternative tax regime. Chapter 6A, yes. In chapter 6A, there is an amendment in 80CCD. Now what is 80CCD? 80CCD talks about notified pension schemes, NPS. In NPS, you get some deduction. There are three sections in NPS: 80CCD subsection 1, 80CCD subsection 2, and 80CCD subsection 1B. What is the difference, sir? Subsection 1 is your own contribution, subsection 2 is employer contribution, and 1B is extra 50,000, which is unallowed in subsection 1. Which is what? Unallowed in subsection 1. Now let me show you the amendment, what it is now. Suppose case 1. The salary of the employee is 10 lakh rupees and the employee contribution is 1.5 lakhs. So how much deduction will be available in 80CCD subsection 1? 10% of salary or amount contributed, whichever is lower. So you will be allowed 1 lakh rupees over here. Okay. Now how much is unallowed? In 80CCD subsection 1, unallowed is 50,000. So this extra 50,000 you can take under 80CCD subsection 1B. Okay. Now case 2. Suppose this is 10 lakh, this is 1.8 lakhs. How much will be allowed in subsection 1? 10% of salary, 1 lakh. How much is allowed in subsection 1? 80,000. So how much you can claim in subsection 1B? You can claim 50,000 in 1B. Okay. Now pay attention. Now the law says that earlier we used to utilize this 50,000 only for making NPS for ourselves. That is for assessee. Now you can utilize this 50,000 for making NPS for minor child also. So this total contribution I am making 1.5 lakhs. Okay. Out of that I can do 1.25 lakhs for myself and 25,000 for minor child also. I am a parent of a minor child, I can make in the name of minor child also. Or if I am a guardian of a minor child, I can make in the name of the minor child also. Parent can make in the name of minor child or guardian can make in the name of minor child. So this 50,000 can be exhausted for your own NPS. This 50,000, not this one, not this 1 lakh, not this 1 lakh. This extra 50,000 can be utilized for your own NPS and it can also utilize for the minor child. Let's take another example, case number 3. Salary is 10 lakhs. Employer contribution is 1.25 lakhs or 1.3 lakhs. How much will be allowed in subsection 1? 1 lakh. How much is allowed in unallowed in ATCCD subsection 1? 30,000. So 30,000 you can claim in subsection 1B for yourself, and now you have a scope of another 20,000. You can make another NPS in the name of minor child also. 30,000 your and 20,000 minor child. The total limit of 50,000 is for you and the minor child taking together. Check it please. If you want to take a photograph, you can take, then I will show you the provision. You can pause the lecture and take it. The deduction under ATCCD subsection 1B page number 26.3 shall also be allowed where any payment or deposit is made to the account of a minor under the pension scheme referred to in said subsection by the assessee. Who can make? Parent can make, guardian can make. Subject to the condition that the aggregate amount of deduction under this subsection shall not exceed 50,000. Aggregate shall not exceed 50,000. My extra and my minor child amount total should be up to 50,000 along with ATCCD subsection 1. The amount on which deduction has been allowed under ATCCD subsection 1B or any amount accrued thereon will be charged to tax when such amount is withdrawn. Whenever you will withdraw, it will be charged to tax. Yes, if it is received on death benefit, okay, then it shall not be subject to tax. If there is a death of the minor, then it will not be subject to tax in the hands of the parents. Okay. Then if you make partial withdrawal, we all know that in case of partial withdrawal, some portion is taxable, some portion is exempt. It is same only. So I am not talking about this much. This is same as what we have done earlier. You can check it over here also for partial withdrawal what happens. Okay, there is nothing new in this. So the amendment, important amendment is the extra 50,000 which is allowed now in ATCCD subsection 1B. That extra 50,000 you can utilize for your NPS and also for your minor child NPS. I hope it is clear to all of you. Next amendment, next amendment, next amendment. Yeah, in ATLA they have again increased the time limit from 2025 to 2030. So you can just check this over here. Earlier this was 2025, now it has become 2030. So nothing great as such. In tax audit, there is nothing great. Whatever amendments were there, I have told you earlier in tax audit. All these things I have told you in last year. In last year means when I was teaching you the amendments of last year. Amendments of Jan 26, we have covered all these points. Now in non-resident taxation, let's see what is the amendment. No great amendments are there in non-resident taxation. Little bit amendment is there. Yes, one amendment which is on page number 28.11, which I have told you last year that this is a mistake. They will rectify in the next year. I have told you in the class also this is a mistake. They will rectify soon. So in 115 AD, what they have done in 115 AD, they have changed this normal LTCG from 10% to 12.5%. If you remember last year, they forgot to make this 12.5%. So now they have changed this also from 10% to how much? 12.5%. Check it please. Okay. So they forgot last year to make this 12.5%. So now they have made it 12.5%. This is the first amendment. Small amendment, nothing great as such. Second amendment on page number 28.15. In 10.4E, they have added over-the-counter derivatives also. Earlier, there was only offshore derivative instrument. Now they have also added over-the-counter derivatives. Plus, earlier there was only offshore banking unit with whom you need to enter into a contract. Now you will also enter into a contract with FPI being a unit of IFSC. So there are two amendments over here. First amendment, over-the-counter derivative has been added. Second amendment, you can now enter into a contract with any foreign portfolio investor being a unit of IFSC. You can enter into a contract with them also in this section. Second amendment in 10.4F, here also they have extended the time limit from 2025 to 2030. Nothing great as such, very simple. Third amendment in 10.4H, they have changed, they have added aircraft as well as ship here also. Here also ship has been added, and here also they have extended the time limit from 25 to 30. So two amendments here, one along with aircraft, now ship is also covered, and 2025 has become 2030. Nothing great as such. Okay. Now, in this Abu Dhabi Investment Authority section also, they have made some changes. Let me show you what changes they have made. 1023 FE. Now, here they have made change. Dividend income is exempt, interest income is exempt, any sum referred in 56(2)(12), that is the income received from business trust, is exempt, and amendment is as follows. LTCG is exempt, whether or not such capital gains are deemed as STCG under 50AA. Now, do you remember there are 4 assets which are always short-term, capital asset as per 50 CA. Now, the law says that if those 4 assets are held for more than 12 months or more than 24 months, as the case may be, then those 4 assets will be called as long-term capital asset. Now, it's a tricky amendment. Be careful. I will explain you again. What do you mean by this? It's a tricky amendment. See, the law has said that we will exempt your dividend. Okay. We will exempt your interest. We will exempt your business trust income. Now, the most important point, the law is saying that we will exempt your LTCG also. From whom? From dead. Now, we all know that if the debt is a debenture or if the debt is a dead mutual fund, specified mutual fund, they are always short term. If they are always short term, then this cannot be long term. Na? So, in short, you can say 50AA section is not applicable here. It means if a debt is long term, as per 50AA it is short term, but for the purpose of this section it will be called as long term so that they can enjoy exemption. If a unit is a specified mutual fund which is always short term as per 50AA, but for the purpose of this section it will be long term. If it is long term, if it is held for more than 24 months. If it is sold within 3 months, then though it is short term only. So, moral of the story, the meaning of this bracket is nothing but provision of 50AA is not applicable for this particular section. In 50AA, 4 items are covered. If those 4 items are long term, then it will be treated as long term only. For the purpose of this section, it will be treated as long term so that they can enjoy exemption of long term. Otherwise, this section is of no use to them. I hope it is clear to all of you. Now, next point. Now, I would like to say one interlinking point over here in 115JG. This is the only case where you are allowed to carry forward losses for another 8 years. This is the only case. Sorry, why they have not amended this? They have not amended this because this is covered in a notification. Wherever there was written in the law, in the act, wherever in the act it was written now, another 8 years. They have removed another 8 years and they have put the word balance. But this is notification. They forgot this notification. In future, they may amend this notification also and they may bring a new notification where they will put balance 8 years, but as of now, this is the only case in the entire income tax law where you can carry forward the loss for another 8 years. That's it. Okay. Now, let's go ahead with the next one. There are some presumptive income sections also newly inserted. Yes, a new presumptive income section has been introduced by the government over here. 44 BBD. What is 44 BBD? Absolutely new section. It overrides section 28 to 43A applicable for non-residents. What is the non-resident supposed to do over here, sir? The non-resident should provide services. What should the non-resident do? Provide services or technology. For what? Setting up electronic manufacturing facility or producing electronic goods in India. So who is the service provider? Non-resident. What is the non-resident doing? He is providing some services. He is providing some technology. For what? For setting up electronic manufacturing facility or producing electronic goods in India. To whom he is providing? He is providing this to resident company. He is not providing to everybody. He is providing to resident company who is also engaged in electronic manufacturing connected facility in India under a scheme notified by the government under Ministry of Electronics and Information Technology. So who is the service provider? Non-resident. What is he doing? He is providing services or technology for setting up electronic manufacturing facility or producing electronic goods. To whom he is providing? He is providing to resident company who is also engaged in electronic manufacturing facility. They should fulfill certain prescribed condition. I don't know what prescribed conditions they will prescribe in future, but they may prescribe in future. I don't know what is that. Then your deemed income will be 25% of your aggregate amount. 25% will be deemed income. That's it. Okay. No deduction of UAD, no deduction of set off of losses. UAD and set off of losses will not be allowed to you. Yes, one point is mentioned over here. provisions of 44DA and 1158 do not apply. It means even if this service is a FTS, still you will apply 44 BBD. Do not apply 44DA and do not apply 115A. If this service is FTS, then also apply this section only. Do not apply 115A and 44DA. I hope it is clear to all of you. Okay. So nothing great as such, a very simple section. Nothing great. One amendment is there in this particular point of significant economic presence. In case of significant economic presence, you have to pay tax in India. But there is one relaxation given that if somebody is purchasing goods in India for export, if somebody is purchasing goods from India only for the purpose of export, significant economic presence will not arise. So if you are coming to India purchasing goods and then selling outside India, exporting outside India, significant economic presence will not occur in that case. Okay, I hope it is clear to all of you. Now, in fund manager of offshore funds, there is one amendment. In eligible investment fund definition, they have made some amendment. What is the amendment they have made in eligible investment fund definition? Pay attention, please, all of you. Point number C. The aggregate participation or investment in the fund directly by the person resident in India does not exceed 5% of the corpus of the fund. Now you have to check this condition when? On 1st April you have to check and on 1st October you have to check. Check on 1st October what is the total corpus of the fund and check how much Indian residents have invested. It should not exceed 5%. Similarly, check on 1st October what is the total corpus of the fund, how much Indian residents have invested, it should not exceed 5%. Now, suppose on 1st April 2025, it exceeded 5%. Then within 4 months, you have to settle that. Check please. Provided further that where the said aggregate participation exceeds 5% on 1st October or 1st April, 1st October or 1st April, in the previous year, the condition mentioned in this clause shall be deemed to be satisfied. If it is satisfied within 4 months, that is on 1st April, pay attention on the board, what do I mean by this? On 1st April 25, suppose it is exceeding 5%, you try to settle it by within 4 months of the 1st April, that is April, May, June, July. By 31st July, try to settle it. By 31st July, try to bring below 5%. Similarly, on 1st October, again check if it is within 5%. If it is within 5%, great. If it crosses 5%, again try to settle it. October, November, December, Jan. By 31st Jan, try to settle it and bring it below 5%. I hope it is clear to all of you. Try to bring it below 5% by 1st of January. So this is a small amendment which is there in this particular chapter, in this particular section. Apart from this, I don't think so there is any other amendment in this chapter. Now, in business trust, one very important clarificatory amendment has come. What used to happen earlier in business trust? Point number 1 was there, 2 was there, 3 was there, 4 was there, 5 was there, and after 5 directly point number 7 was there. And apart from these 5 items, all other incomes were subject to MMR. Now if you check this properly, apart from these 5 items, all other items were subject to MMR. Now if you check this properly, in these 5 items, 112A capital gains was not coming. Therefore, 112A capital gains were subject to MMR. 112A capital gains were subject to what? It was subject to MMR. Now that was a very, very big setback for the assessee. That was a very, very big problem for the assessee. Because in point number 1, 2, 3, 4, 5, 112A capital gains were not covered. So if it is not covered, it has to go to MMR. So now Finance Act 2025 has clarified that no, 112A capital gains will be subject at normal rate of 12.5% subject to 1.25 lakhs in the hands of business trust, and investor is exempt in that case. So 112A capital gains will also be subject to tax at normal rates, not at MMR. Normal means 112A rates. 12.5% tax subject to 1.25 lakh exemption. I hope it is clear to all of you. Is it clear? I hope it is clear. Let's move on to the next amendment now. In DTAA, there are no amendments. In transfer pricing, there is only one amendment which I will cover in part 2. That is the amendment with respect to transfer pricing officers. This I will cover in part 2, don't worry. Okay. There are 2 things which I will cover in part 2. One is search and seizure amendment and one is transfer pricing amendment. Safe harbor rule I have already discussed with you all on YouTube, which was applicable for Jan 26 also. Vote for advance ruling, no amendments. Compounding of offences, no amendments. Car, no amendment. Vodafone case law, no amendment. Then all these theory topics. Now in tonnage taxation, they have made one small amendment, and that is earlier tonnage taxation was only applicable to sea-going vessels. Only sea-going vessels were covered in tonnage taxation. Now the tonnage taxation provisions have also been extended to inland vessels. Check it, please. So earlier it was only be available to sea-going vessels. Now it has been extended to inland vessels also. Let's check the amendment. To promote inland water transportation. Sir, what is inland vessels? Which runs within the country, in rivers, etc. To promote inland water transportation and attract investments in the sector, the tonnage taxation scheme has been extended to inland vessels. Accordingly, inland vessels are now included in 115 VD as eligible to be qualified ship. Inland vessel includes any mechanically propelled or non-mechanically propelled inland vessels registered under the Inland Vessels Act 1921 and plying in inland waters, but does not include a fishing vessels or any vessels as not to be inland vessels by the notification by central government. So they have made amendment that the amendment is very simple. Whatever provisions were applicable for sea-going vessels will be applicable to now inland vessels. That's it. That's it. The entire chapter will now be applicable to inland vessels. There are more than around 25 sections in tonnage taxation. And in all the sections they have added inland vessel, inland vessel, inland vessel, inland vessel, inland vessel, inland vessel, inland vessel. So that they can extend the benefit of this to inland vessels. That's it. That's the only amendment. Second amendment is how to join the scheme. If I want to, this is an optional chapter. This is not mandatory. If you want to come, come. If you don't want to come, don't come. That's your choice. So how to join the scheme? For that you have to make an application. After you make an application, the Joint Commissioner will pass an order. In how much time? That time limit was not there in the law. When you should make an application, that time limit was there. But when Joint Commissioner should pass an order, that time limit was not there. So they have passed that time limit also. The Joint Commissioner will pass an order accepting or rejecting your application. This time limit was missing earlier. Within 3 months from the end of the quarter again, end of the quarter, now they are using this word again and again, quarter word. So at some places it is written month, at some places it is written quarter. So we have to remember that now. So by when the Joint Commissioner will accept or reject your application and pass the order that you are eligible for tonnage taxation or you are not eligible for tonnage taxation. He will accept or reject within 3 months from the end of the quarter in which the application was received. So whenever application was received within 3 months from the end of that quarter, he will consider that application. Okay. Now, in miscellaneous amendment, there are some amendments. First of all, in 72AA, again in case of amalgamation of banking companies, etc., or amalgamation of government companies, etc., you will be allowed to carry further losses for balance number of years only, not for another 8 years. Here also you will be allowed. I am not slightly well today. My throat and my nose are gone. So please bear with me. So in case of amalgamation effected before 1st April 2025, it was allowed for another 8 years. But if the amalgamation is effected on or after 1st April 25, then you will be allowed to carry for the losses for balance number of years, not for another 8 years. Okay. Now next amendment is a very dangerous amendment. Which is on National Savings Scheme. Now you need to understand the meaning of this National Savings Scheme. This is an old scheme which was brought by government long back. Where the government used to say very long, around 40-50 years old scheme is there. Try to understand the entire scheme over here. What I am trying to say, otherwise you will not understand the amendment. Now National Savings Scheme. There was a section 80 CCA which used to say, subsection 1, that if I contribute to National Savings Scheme, I will get deduction. If I contribute to what? National Savings Scheme, I will get deduction. But that deduction is allowed only if contributed till 31st March 1992. If you contribute till 31st March 1992, deduction allowed. It means obviously after this, if anybody is contributing, deduction not allowed. First of all, you need to understand this old provision. This is a 40-50-year-old scheme, National Savings Scheme. All those who have contributed till 31st March 1992, they were given a deduction under Chapter 6A TCCA. On or after 1st April 1992, this deduction is disallowed, not allowed. Okay, this is the first thing. Now, the second issue. This is not an amendment. This is a just old history that I have to tell you to explain you the amendment. Now, obviously, if deduction is allowed, and if you withdraw the money which was deposited here, it should be taxable also. And obviously, if you withdraw the money which is deposited here, it should be exempt. Common sense, no? Any amount contributed till 31st March 1992, it was allowed as a deduction. Therefore, when it will be withdrawn, it should be taxable. And any amount deposited after 1st 1/4/1992, it is exempt. It is not subject to deduction. So, because it is not subject to deduction, you should also get exemption on withdrawal. Now, they have played one game very recently. What game they have played very recently is as follows. No interest is payable after 30th September 2024. They have said that we don't have money. The government said that we don't have money. After 30th September 2024, we will not pay you any interest. Now what will happen? You think logically. Think logically that you have deposited money here. Forget this. This money is anyways exempt. Whenever you will withdraw this money, any amount contributed after 1992, whenever you will withdraw, that is always exempt. Don't talk about that. So think about the amount which is deposited here. The money was deposited before 1992. It is still lying in NSS. Now the government is suddenly saying from 30th September we will not pay you interest. What will you do with the money? Will you keep it in the account or you will withdraw? Everybody will go and withdraw their money now. Obviously, if it is lying with the government and the government is not willing to pay you interest, why will you keep your money there? You will take it back. So they know that everybody will come and take it back. So they said, whomsoever will come and take it back, we will make this money also exempt. Don't worry. Whomsoever will come and take the money back, will withdraw the money, we will make this also exempt. But unfortunately, this has been exempted only for individuals. They have not made this exempt for HUF. It means if an HUF withdraws now from this portion of the money, see, this portion of the money is always exempt. This portion of the money was taxable earlier. But now this portion of the money is also exempt for individuals. For HUF, it is taxable. I hope it is clear to all of you. What blunder they make, chi. Blunder they have made. Amount withdrawn from deposit made prior to 1992 is exempt by individuals, not by HUF. HUF have to pay tax. Now let's go ahead with the next point. That is one of the most important part, that is tax rates now. In tax rate, they have made lot of issues. First of all, they have changed the slab rates once again in the new regime. In the new regime, slab rates have changed. Up to 4 lakh income, no tax. Above 4 lakh, up to 8 lakh, 5% tax. That will amount to 20,000 rupees. Then from 8 lakh to 12 lakh, 10%, that will amount to 40,000 rupees. From 12 lakh to 16 lakh, that will be 15%, that will amount to 60,000 rupees. Then 16 lakh to 20 lakh, that will be 20%, that will amount to 80,000 rupees. And then 20 lakh to 24 lakh, that will amount to 25%, that will amount to 1 lakh rupees. So try to buy hard this. Till 24 lakh rupees, if you total this, it will come to 3 lakh rupees. So tax till 24 lakhs is 3 lakh rupees. This is the first amendment that you need to keep it in mind. Earlier the slab rates were different. It was 3 to 7, 7 to 10, 10 to 12, 12 to 15. Now the slabs have become very easy. These incomes are increasing by 4 and tax rates are increasing by 5. Up to 24 lakh, the tax is how much? 3 lakh rupees. Above that, it is 30%. This is the first thing. Okay. First amendment. Amendment number 2, the rebate limit is also increased to 12 lakh rupees. Up to 12 lakh rupees, 100% rebate. Up to 12 lakh, what is the tax rate? Check here. Up to 12 lakh, the tax amount is 60,000. So full 60,000 is rebate. Full 60,000 is rebate. Up to 12 lakh rupees, full 60,000 is rebate. Okay, I hope it is clear to all of you. Now, the biggest blunder they have made is check. For that, I'll make a chart for you all. This is new regime. This is old regime. What is the rebate limit under new regime? Under new regime, 12 lakh, and the amount is 60,000. Under old regime, 5 lakhs, and the amount is 12,500. Okay, this everybody knows. Now, this is not the catch. The catch is, against 112A long-term capital gains, can I get rebate? No rebate. Against this income, no rebate under 87A. No rebate under 87A. Why, sir? Because it is very clearly written in the law. It is written in 112A section only. There is no doubt about 112A. Against 112A income, you do not get rebate under 87A also. You do not get rebate under 87A in old regime as well as new regime. It is a well-established principle. What about other special incomes? What about other special incomes like 111A, 112, etc.? There was a debate. Technically, you should get, but the assessing officers used to not give. Then there are some high court and tribunal judgments which says that no, you have to allow. You have to allow against 111A, 112 and other incomes. There it is not mentioned that you will not get rebate against these special incomes. Only against 112 it is not allowed. So they made an amendment that against the special incomes also no rebate under 87A. No rebate under 87A. This is the Finance Act 2025 amendment. But these hopeless people, what kind of amendment they make? They made this amendment only in new regime. They forgot to make this amendment in the old regime. Therefore, now in the old regime, it will still be allowed. They did not make this amendment in new regime. They made this amendment only in 115BAC subsection 1A. And 115BAC subsection 1A, we all know, is new regime. So, moral of the story is what? If there is an LTCG under 112A, then against this income rebate is not allowed in old and new, both. But if there is an other LTCG or STCG or any other special income, even against this incomes rebate will not be allowed in new regime, but against old regime it will be allowed. This is the area of distinction. Please carefully check this particular table and write down this somewhere. And take a photograph of this and write down. I'm pausing you can pause the lecture and write it down. Okay, very important amendment. I've written it over here. In book it is there obviously, but you can take a photograph also. Apart from this, there is no amendment here. Rest all is same only. So in old regime I have written rebate under 87A shall not be available against 112A. It means it shall be available against other special income. Very important line. And in black money law, there is a small amendment. That said, this is the last amendment. In black money law, you all know that on page number 44.6, there are some penalties in black money law. If you fail to furnish the return, 10 lakh rupees penalty, or if you fail to furnish information in the return, 10 lakh rupees penalty. But now this 10 lakh penalty will not be applicable to certain people. Earlier the limit was 5 lakh. Now the limit has been increased to 20 lakh rupees. The limits have been changed as follows. This penalty of 42 and 43 would not apply up to 20 lakh rupees value of asset, but this 20 lakh rupees limit is not applicable for immobile property. It is written other than immobile property. It means if you have a foreign bank account, if you have a foreign jewelry, if you have foreign other assets, if you have foreign shares, foreign debentures, and if it is up to 20 lakh rupees, and if you don't report, it's okay, you will not be liable with penalty. But for immobile property, you have to report even if it is 1 lakh rupees. For immobile property, this 20 lakh limit is not applicable. Check it please. This is a small amendment in black money law. So that's it. This is what the amendments of Finance Act 2025 is all about, and my commitment towards my dearest students of full English is completed. I will be uploading one more part. That will be a very big part, around 2-3 hours, which will cover the entire search and seizure block assessment and transfer pricing amendment. Okay. So very soon we will also come with the revision videos. The revision videos we are already uploading. We have uploaded PGBP, we have uploaded TDS, we have uploaded NR taxation, we have uploaded capital gain. All important topics are already uploaded for you all in full English. Now we are also going to upload the MCQ video in next 8 to 10 days. I will also upload the MCQ videos in full English for you all. So till then, take care all of you. Bye. See you soon.